panelists can talk about their experience and give a brief overview of the fund. Mark, why don't you kick it off?
Sure. Good afternoon, everyone. We started off life in 1993 as a private equity firm investing in family businesses that were going through succession issues and generational change. And from 1993 to 2009, we focused on controlled private equity investments, minority investments in those size businesses, perhaps 75% of them in the United States and 25% outside the United States. After the recession of 2008, 2009, we found that a lot of the families with whom we were investing would ring us and say, we really need a loan. The banking sector is closed. We don't have any assets in our business. We're cash flow businesses. And so we decided to raise a debt fund. So we raised the first debt fund in 2009 and then subsequent funds. So structurally today, we're a publicly listed BDC, business development company. That entity has underneath it a series of funds, including an SBIC fund. We provide loans of all different types, senior loans, mezzanine loans, preferred stock. We customize the loans to the needs of the family or the business owner. We'll provide some equity if needed. The businesses, unlike the panel you heard before lunch, that really is pure venture. For us, it's cash flow of at least $3 million, generally $3 million to $15 million. These are businesses generally with no assets, so healthcare services, business services, logistics businesses, some niche manufacturing businesses.
Thanks, Mark. Bill Huncher, I'm a partner with TZP, and TZP's been around since 2007. We have in total around a little over $700 million under management through 3 funds. First 2 funds are geared toward larger businesses in the middle market. And throughout TZP's history, and when I say larger, $10 million and up in EBITDA, and check sizes of $25 million and up. But throughout TZP's history, half the deal flow that came in were otherwise great businesses with great management, great growth potential below that threshold. And so, unfortunately, the firm had to sort of move on. We got the idea to create a third fund called TZP Growth, which would do $8 million and below in EBITDA, and check sizes sort of a minimum of 10 to 20, and sort of cover the lower end of the low middle market with high growth companies, still somewhere between their C round and ultimately becoming a large company and going public. So there was still some work to do, but clearly the model was proven. There was cash flow, there was EBITDA, yet they were a little bit less developed than your traditional private equity fund. So that's where we're at.
Hi, my name is Honest Richardson. I'm a partner at Palisades Growth Capital, and we are a private equity firm based here in Los Angeles. I've been here since 2003, and we essentially straddle the investment area between venture capital and private equity. So we make growth stage minority investments in technology, media, and telecommunications companies. And essentially we look for companies that have, roughly 5 to 10 million in revenue, and they have some profitability, or they're at or near profitability. Historically, we've also made some investments in Northern California, but with our current fund, we're looking to invest primarily in Southern California. And we're also looking at a variety of industries and businesses that essentially use technology as a way to further their business interests. And we look at companies that are essentially more efficient in terms of how they use their capital. So we look to make $5 to $10 million investments in companies primarily in Southern California in technology, and we're currently out looking for deals right now. So if you have any, please let us know.
Well, the panel talked about companies that not only have recurring revenue, but also are profitable. I think, Anders, your your fund can look at a company that maybe is less profitable but in hyper-growth mode. Why is recurring revenue so valuable, and how do you assess whether it's either repeatable revenue or recurring revenue, and what is that difference? Bill, we just concluded a transaction with a company that had significant recurring revenue, and how do you look at those businesses?
Yeah, it's an interesting model for recurring revenue. Let me get to that eventually. But, we looked at 650 businesses, potential deals last year, and we're always balancing risk with opportunity, with growth, and really focused in on the integrity and the repeatability of the revenue stream. And obviously I'm preaching the converted here, but recurring revenues, fit that bill. And to sort of take a different twist on it, the cold hard facts are, we are creatures of economic return. And, we are equity investors, but at the stage of investing that we're at, we borrow money. And to have some visibility into growth allows us to borrow more money than if it's an earlier stage company, which increases our return, which ultimately increases the valuation of businesses with more recurring revenues, if that makes sense. So, the rubber hits the road, the more recurring revenues exist in the business that are provable, naturally the higher the valuation's going to be. But the business that Bruce represented, it's a company that does outsourced library services, among other things. And one of the growing business units is called Library as a Service, which we've actually trademarked. And it is very much a recurring revenue, a distributed knowledge model where, somebody in an associate in a law firm in New York says, I need 14 cases on the following thing. We have industry experts around the country, and through a portal that's been developed, can access that information real time as if that researcher was in the same room. This is a model that can be transported to smaller law firms and other businesses around the country, and so there's a potential membership model that exists there. The business in and of itself is, you can imagine, when a company outsources its library, and some of these law firms have $25 to $30 million libraries that are kind of a black hole. They've just been there forever. We do it a lot better. And once a sort of mission critical but non-core competency is outsourced, and we did this in our due diligence, really confirmed that these businesses are loath to bring it back in. In fact, it won't happen. So it's a synthetic, if you will, recurring revenue because we have such faith in the stickiness and the value proposition of the company we bought, as well as the library as a service. So as a private equity company, we really are trying to, buy companies or invest in companies that have that component either existing or can be built.
And Mark, OFS has more of a lending focus. How do you assess the predictability of recurring revenue?
Yes, so to the extent we take a minority equity position in a company, we look at the same things that these gentlemen do, which is the growth. But we're primarily a lender, and we won't make the equity investment without the loan. And as a lender, it's nice to speak about revenue, but we look at cash flow. And we look at cash flow that is real free cash flow, available cash flow. That's after all capital expenditures, after all other expenses in the business. So on the one hand, we have financed an alarm business. We've invested in the alarm industry since 1994. And in that case, like in any industry, there are metrics you look at. There is it high-end residential or low-end residential? Is it commercial? What are the monthly revenues? And in particular, what's the attrition rate? So in the one transaction we closed a year ago, we lent 38 times monthly recurring revenue, of which 31 times was in the form of a senior loan and 7 times was the junior loan. And in that particular business, the attrition rate was under 10%, which is extraordinary for an alarm company. Where One doesn't have any form of monthly recurring, but one does have repeatable cash flows. We have a healthcare business that is involved in healthcare marketing and communications, and we act for very large companies like Johnson & Johnson, and they come back each year, and we handle marketing activities for them. So on the one hand, it is repeatable. We know the customers come back, and we know roughly what we do. It's not what I would call recurring, because the amount of business we will do with them each year is constantly changing. So in that case, we'll provide the capital, but the loan may be levered at 2.5 to 3 times annual cash flow. And unlike some of the early venture businesses you heard about this morning, we don't look at pro forma what's going to happen tomorrow if the sun shines. We look at what happened in the prior year, what happened in the years before that, how long has the business been around, and where is it likely to go. And then we have just one more example. We have an electronic health records business, another healthcare business, but in that case, very, very predictable and very recurring, because doctors and other healthcare providers will pay us a monthly fee to maintain their records. And in that case, the leverage can go to 4 or 5 times historical free cash flows.
Thank you. Let's talk about enterprise value, and a metric that was addressed earlier by some of the panelists was the lifetime value of a customer. Anders, you look at lots of growth companies. How do you assess that value?
So, as you mentioned, there was some discussion earlier today about that, and I certainly am not trying to dodge your question. I think that there are a lot of fairly simple models and rules of thumb to calculate what the lifetime value of a customer is, and unfortunately, I don't think I have, some new way to look at it to tell you that this is how you do it, but I think it's really important, particularly for, since we're at a recurring revenue conference, recurring revenue SaaS businesses, is to really look at the flip side of lifetime value of a customer, and that's really your customer acquisition cost. And if you're not able to deliver a customer at the appropriate cost level, you're never going to be able to scale your business. You're never going to be able to develop a profitable business. And I think a lot of companies tend to fall into a trap where they use fairly simplistic models to talk about what your customer acquisition cost is, and the reality is that customer acquisition costs really permeate your entire business, and it's not that easy to measure it and manage it. And so the most obvious one that we all think about is sort of feature and product creep, right? And that comes in through professional services, through your IT team needing to make changes to the product. And either that's someone coming in and saying, hey, I'd love to buy your product, but I need X, Y, and Z features. And then you say, okay, am I going to build that? Or your salesman says, hey, I could sell this product, but I need X, Y, and Z feature. And so those start to come into your business, and those are real costs that you need to manage. And obviously, earlier on in the life cycle of a business, you certainly need to do some experimentation to basically formalize your product and get it ready to market. But sooner rather than later, you really need to start moving away from that customization into productization, or you're never going to be able to grow the business. So you do not want to have the tail wagging the dog, and you can't lose control of your product roadmap by allowing sales and your customers to determine the way that you run your business. And similarly, I think you really also need to look at your sales cycle, and I think you need to look at your implementation cycle. So if you are a company that has a year-plus sales cycle, or you have a 3 to 6 months implementation cycle, that's going to be a very difficult business to scale, and it's going to be very difficult to get to profitability. So I would just encourage people to sort of look beyond some of the simple models, because you're going to get yourself in a very difficult financing quandary, because in a SaaS business, when you start generating revenue, you're already in a cash flow negative business, right? Because you're going to have to amortize a bunch of costs up front, and if you lose control of those, you're going to be in some pretty tough sledding. So I would just encourage people to look at that in light of thinking about the lifetime value of a customer, because there are many customers out there you probably shouldn't be serving. There are probably far more customers out there that you cannot serve profitably. So I think you've got to get your salespeople and your IT and your product roadmap and make sure that you are able to service your customers in a scalable, profitable fashion.
So it comes down to profitability. So, Mark, when you look at a credit opportunity and somebody puts out a lifetime value of a customer, are you looking at the underlying cash flow to underwrite the financing?
Yes, we do an analysis of the customers, what mathematically is called a cohort analysis. So all one is really doing is aggregating the customers and then subdividing them into categories. So if you have 1,000 customers, you look at their spending habits, but you'll aggregate them over periods. So you may put all the customers who signed up in year one in one bucket, those in year two, in year three, and year four. Then you'll look at the spending habits and the costs to acquire all those in year one. And then as they come into year two, you'll see, did the spending habits increase or decrease? Did the costs increase or decrease? And so you can do an analysis as to what happens to customers over time. We do the same analysis as equity investors do. The difference is, whereas an equity investor can make 5, 10, or 20 times their money, a lender's goal is to get your money back plus a smaller return. So we're very focused on the enterprise as a whole, and how the mix of customers interrelate with each other and the sustainability of that customer base, as opposed to the customers in year two are not spending as much as the customers in year one versus year three.
That's fascinating when you consider, one of the panelists said earlier that paid customers perform worse than organic customers. So it certainly shows up on the financials when you are able to bring in a customer without having to pay high acquisition costs. Bill, from your perspective, what metrics are exciting to TZP as you evaluate an opportunity?
Yeah, as I said earlier, we looked at 650 businesses last year, and we ended up investing in 4. And so and I didn't sort of say in the beginning what we looked at, but we are very much generalists, like consumer, outsourced business processes, digital is an area we're really interested in, and a bunch of other different verticals that we do. But so because of that, we have seen every metric, and each metric is unique to whatever vertical you're looking at. We actually looked at a deal last year where these guys, talking about repeatable revenue versus recurring revenue, they had contracts with malls around the country, and at Christmas time they would supply these malls with Santas. And so the metric there was the highest percentage of naturally bearded Santas was. But anyway, but you look across the franchise
On 1 day a year.
On 1 day a year, yeah. But no, it's as you might imagine in the media space, if it's print, it's the subscriptions and the renewals of the subscriptions. In the digital space, it's, as you all know, those metrics are pretty straightforward in terms of uniques and sell-through and all that sort of stuff. And so we, by virtue of the place that we sit, really are very vertical specific in terms of the metrics. But recurring revenue. Every book we see on any company that comes to market, there is a focus on, well, let's talk about what portion of our business is recurring revenue versus repeatable or one time. And the notion of not having to earn your revenue every year, turning your new revenue into permanent revenue, and then so you're playing offense all year long the next year. Is a beautiful thing. And those are the kinds of businesses, whether it's obvious or whether we need to work hard to add value to morph it into more of the recurring revenue model. That's really an area of focus of a lot of private equity firms at our stage of investment.
Well, it sounds like you've been working with some creative investment bankings on that Santa deal, because
genius investment bankers.
Well, the great thing about being an investment banker is you don't have to follow GAAP. You could create your own metrics. Anders, from your perspective, are there any metrics that Palisades hones in on?
Yeah. So, we sort of straddle the investment area between venture capital and private equity. And so I would say the three metrics that we tend to focus on are revenue traction, margins, and then scalability. So as far as revenue generation goes, we're looking at, roughly 5 to 10 million in revenue. And what we want to see is essentially a proxy for the value of your product in the market. So it's relatively easy to sell, a few million, maybe 500,000, a million in product. And perhaps when we go in and do diligence, we might be able to tell, oh, your product's better than this, your product's better than some competitor. But once you're able to sell at a certain level to some pretty viable customers that are referenceable, that makes a big difference to us. And that's where we spill into sort of the second metric. So it's one thing to sell revenue, but to be able to do it profitably, that really tells us that not only does someone think your product is worthwhile, but they're willing to pay you a significant amount for it, and you're able to deliver it in a profitable way. And so the third, it's not really a metric, but we really look for is scalability. So again, important thing for recurring revenue SaaS businesses. We really want to see a product that is designed for scalability, a management team that is designed for scalability. If you just need to add people to continue to build your business, it's very difficult to grow quickly. And some of the mistakes that we've seen is smaller companies tend to be fairly reluctant to implement processes. And when I say mistakes, I'm not sitting in a glass house throwing stones. I've been through this with entrepreneurs and we've experienced it. It's very difficult as you grow a business, if you aren't set up for scalability, if you grow it into a $10, $20, $30 million business, without that, you're going to have to start pulling stuff out, and it doesn't work. So I would encourage people to really focus on the scalability processes early on in your life.
Yeah, and if I could pick up on Anders' point that, when we sort of pick up where Anders drops off in terms of sort of the size of the business and the maturity of the business, and we're always talking about degree of incompleteness. And again, in the asset class that we're in, there's going to be, based on the size of the business, some incompleteness. And, one of them is, can this management team really scale this business? Have they done the work to do it? And, we've passed on some otherwise pretty interesting business because we just didn't feel like the scalability was doable without a whole lot of time and money and risk, frankly.
Can we touch on when venture capital becomes private equity? Because your fund, Anders, blurs the line, and if you could briefly give some perspective as to how you see those two markets intersecting, or if they don't.
Yeah, so I think traditionally venture capital has been smaller check sizes to earlier stage companies for high growth, companies that tend to be negative cash flow, and you're trying to build them up into something. And similarly, traditionally, obviously you guys can speak to this as well, I think private equity has usually been considered majority controlled, later stage businesses that have cash flow and typically use some form of leverage as part of the transaction. And so I think over the last 10 or 15 years, you have seen some bleeding downwards and upwards, and a lot of times what you'll see is fund managers hire other teams. So earlier stage funds hire later stage teams to go further in. And so you tend to have these asset managers build up a variety of teams. Maybe they'll have a debt fund, or they'll have a late stage fund, they'll have a private equity fund. But I think as far as those two traditional definitions of venture capital and private equity, it doesn't seem to me like it makes a lot of sense for a private equity investor to move into venture capital as the same investor, given that I think the investment mindset and the skill sets are very different in terms of what it takes to be successful in either one of those. So I think you'll see different asset managers hire different managers to go after various asset classes. But I think what you may be alluding to is, more recently, I think what we've seen in the venture space, particularly in the later stages, we've seen a large number of non-traditional investors coming in to invest in later stage venture capital business. You'll see hedge funds, mutual funds, insurance companies crowdfunding, a whole variety of people coming to invest in the space. And I think what's attracted them, it seems to be really sort of the headline, huge deal, huge returns. And so I think a lot of those investors in their respective spaces have seen much lower returns in the public markets and debt markets.
Right.
And so I think they may have been chasing, something there. And it's pretty dangerous. I think what it's led to is obviously the unicorn phenomenon that we're all familiar with. I think you see, huge increases in valuations, significant supply of investors, and I think we're probably in a similar situation as the dot-com bubble, where we're going to have to see the rat pass through the snake, and I think we're starting to get there. But I think it's going to be difficult, right? Because in the dot-com era, you had basically a lot of companies that got funded that sort of petered out, and they sort of ran out of business. I think the situation we're in now is you have very large companies that are probably not necessarily cash flow break-even with huge war chests.
Right.
And shutting those down is a little harder.
And part of the drive in valuation has been driven by the availability of debt. And Mark, from your perspective, how has debt played into driving valuations for a lot of these companies?
So since 2010, 2011, capital has been plentiful and its cost has been low. So it's clear that companies can borrow. Debt is supposed to be less expensive than equity, so companies are borrowing as much as they can, but not all debt comes in the same flavor. There's venture debt, which to us is like true equity, and there's real debt, which is less expensive. We're clearly seeing some of the lenders who have been active in the last 4 years have problems. We're seeing loan losses increase. We're seeing accruals increase. It's not just oil and gas, it's across the sector. So it's clear that capital, especially in the loan market, whether it's mezzanine or senior or a form of preferred stock or a hybrid, it will become less available. There's still a lot out there, but it'll be less available. It will be lent on not only higher interest rates, but more stringent terms. And what I urge you all to worry about is not the extra quarter of a point here or there in cost, but as the market, the general economy turns, is this a lender that is more a vulture, or are they more a partner who will work it out with you? And that's what will determine who really survives in our end of the market.
And where do you fit in?
I'm not answering.
Let's open it up to some questions.
I guess I'll take that. I think Anders talked about private equity companies and venture capital investors sort of starting to bleed together. And in my fund, it would be very difficult for us to invest in something as a multiple of revenues. Again, we're looking for growth stage companies, but with some identifiable cash flow and EBITDA. And if not, we will invest in a company with zero of EBITDA and cash flow, but you've got to be able to turn the dials fairly quickly, to sort of morph a company from investing in growth to starting to harvest some of that potential. But it's a tough one. We've had some long conversations about, this business is beautiful. We love it, and the management's great, but 4, 5, 6 times revenues is not the promise that we made to our LPs. So we would probably, move away and more toward the traditional, if you will, as Mark talked about, cash flow-based businesses. And it's more Anders, bailiwick than private equity per se. Right.
Any other questions? Great. Thank you very much. Good job.